Today's highlights: Powell cut rates, but Bitcoin remains at the critical line between life and death. Ethereum is speeding up financialization, and Solana has a new player, junk bond. Junk coins are turning into gold, and institutions are still continuously increasing their positions and accumulating coins. Will this bull market turn into a game dominated by institutions? The latest data from Yahoo Finance is quite striking. Why? Because the hype around Bitcoin spot ETFs has faded even faster than expected. At the beginning of October, the average daily trading volume was still between $7 and $8 billion, but now it's down to around $4 billion, almost cut in half. The impact is significant, and the reason is clear. The Federal Reserve cut rates by 25 basis points last night, but institutions are still holding cash tightly. Tariff negotiations between China and the US are not finalized, so the market fears risk and everyone is moving to safe haven assets. Currently, ETF trading volume is supported by just 3 firms. Also, GBTC accounts for over 80% of the trading volume. In fact, ETF trading volume has been shrinking continuously since October, as both institutions and retail investors have become more cautious. Simply put, we're currently in an awkward period of policy observation and liquidity transition, so the market is especially prone to sharp fluctuations in both directions. So once the situation becomes clearer, risk-averse funds are likely to return, and the trading volume of Bitcoin and other crypto ETFs will probably recover. This time, the Ethereum Foundation is truly preparing to welcome guests. According to a scoop from Cointelegraph, the Ethereum Foundation has launched a new website. They've directly provided banks, funds, and brokerages with an on-chain manual, and right from the start, they're showing off big numbers. That's because RWA, real-world assets, account for 75% of the market share on Ethereum, DeFi makes up 65%, and stablecoins 60%. On top of that, Visa processed $1 billion in stablecoin transactions on Ethereum last year, BlackRock has $1.15 billion in assets under management on Ethereum, and Coinbase has locked up $15.5 billion also on Ethereum. So this trend is clearly sending a message to the market. Ethereum is no longer just for geeks. It's now the main track for institutions. Now, the competition isn't about who speculates more, but who can keep more institutional money on their chain. So, let's look at Coinbase's Premium Index, which has been interesting lately. Whenever Bitcoin drops below 110,000, institutions rush in to buy the dip. But as soon as it climbs above 110,000, the premium turns negative, as if the market is always hovering around this price. Everyone is playing it safe, and $110,000 is now the battleground for crypto. From a macro view, the Fed's rate cuts aren't aggressive enough, and China-US tariffs remain uncertain, so no one in the market dares to act rashly. Still, the premium is within the political range. What does that mean? The institutional money is still there, and confidence hasn't fled. There may be short-term volatility, but the long-term and bullish momentum hasn't dissipated. Right now, Bitcoin is no longer being speculated on by retail investors. It's being accumulated by institutions. As of October 30th, publicly listed companies around the world collectively hold 1,043,300 Bitcoins. That's a market value of $115 billion, which accounts for about 5.2% of the total circulating supply of Bitcoin. Just this past week, publicly listed companies bought another $225 million worth of Bitcoin. You could say that's no small amount of buying power. Big Brother MicroStrategy is still firmly in first place, holding 640,000 Bitcoins worth $71 billion. Following them are Marathon and Watitwood, with 53,000 and 43,000 Bitcoins respectively. Since the end of last year, publicly listed companies and institutions have been buying more and more, and this trend hasn't stopped. Even though the macro environment is still shaky, Wall Street's attitude toward Bitcoin has changed. It's no longer just speculation. They're truly treating Bitcoin as digital gold and stockpiling it. So right now, the total market value of publicly listed companies is only $115 billion. In the future, as stablecoins and regulatory compliance are implemented, traditional capital may soon step into $1 trillion track. Simply put, Bitcoin is transforming from a speculative asset into a strategic reserve, and 2025 to 2026 is likely to be the critical period for this complete transformation. Alright, please like this video and turn on the notification bell. We'll help you sort through the Web3 world's news that's closest to making money in the past 24 hours, and you're also welcome to become a member. From Monday to Friday, basic members will receive a small token each day, teaching you how to buy and sell, where to buy and where to sell, so you can experience the fun of trading. Let's look at the news. Yesterday, the Federal Reserve, which everyone was waiting for, finally made a big move, cutting interest rates on one hand and shrinking the balance sheet on the other. Specifically, they cut rates by 0.25 percentage points, bringing the interest rate down to between 3.75% and 4%. This is the second rate cut this year. At the same time, they also announced that starting from October 1st, they will stop shrinking the balance sheet. In other words, they will no longer pull money out of the market and back into the Federal Reserve because they're worried the market might run short of liquidity. Cutting interest rates is like lowering the cost of water. It makes it cheaper to use. Stopping the balance sheet reduction means there will be even more liquidity, essentially humidifying and prolonging the life of the entire financial system. Powell's logic is actually very clear. Don't let the market get too dry or develop cracks, because that would make things difficult. However, Powell also made it clear that this is just a temporary measure to prevent dryness. He didn't say there would definitely be more liquidity injections in December. So, listening to the whole press conference, Powell came across as the typical central banker, steady but a bit timid.
Even though the latest decision sent a dovish signal, Chairman Jerome Powell still tried to cool down the market during the press conference. He emphasized that it is still uncertain whether there will be another rate cut in December. Powell pointed out that the U.S. economy is facing two-sided risks. On one hand, job growth is slowing, the unemployment rate has edged up, and economic momentum is weakening. On the other hand, the core inflation rate remains around 2.8%, which is above the Federal Reserve's long-term target of 2%. This indicates that price pressures have not fully subsided.
Carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
As of late October, the Federal Reserve's balance sheet still stood at $6.59 trillion. Pausing the balance sheet reduction means that liquidity has not yet tightened. This move reflects its balanced approach between supporting growth and controlling inflation. For the crypto market, short-term rate cut expectations have cooled and sentiment has turned cautious, but the liquidity floor remains stable. Although Bitcoin has pulled back, it is still supported. Stablecoins and the mining sector can catch their breath for now.
Actually, I think it's pretty tough for Powell right now. He has to watch out for employment data, can't let the numbers slip, still has to keep inflation in check, and also has to be wary of the US president possibly asking him to resign at any moment. So, as long as the market gets even a single-sided data point, it could make Powell change his mind. So, since there was already a rate cut in October, will there be another one in December? I think, judging by the current momentum, there probably will be. Think about it. If there's no rate cut in December and liquidity is pulled back, then the performance of the US stock market would probably look even worse than the crypto market, right? So could this end up handing Trump a report card for his second-term midterm elections? I think Powell usually would do that. At Solana parties, the most famous is Palm Farm. It's basically a token factory. Right now, there are over 13 million crypto assets in total, and just by launching a fun token every day, tens of thousands of meme coins can be created. So do you think liquidity can really be good in this situation? Can altcoins really take off? With so much liquidity being diluted, right? But now, there's a new player who doesn't play by the rules called Junk Funk. So what's behind it? It has Bug backing it, and Manta has invested in it, taking a reverse approach into something called the junk coin economy. What does that mean? Some tokens have already lost their liquidity, or they've lost their market value, or no one pays attention to them anymore. But Junk Fund wants to turn these forgotten tokens into rewards and a medium for value circulation. To put it bluntly, it's like flogging a dead horse, reviving those tokens that are already dead and injecting foundational energy into the entire market. It sounds great, but is reality really that promising?
JackFen is a recycling platform mechanism on Solana specifically designed for junk tokens, combining a scrapyard with an alchemy workshop. Users can batch transfer worthless tokens to the platform to execute burn or account closure operations, recover funds, and exchange them for credits, which can be withdrawn as SOL or used to participate in lottery airdrops. It allows useless tokens to regain value. It clears on-chain redundancies and reshapes community liquidity, focusing on the potential for community and liquidity regeneration, turning dead weight into on-chain fertilizer. However, the project is still in its early stages and the mechanism may be adjusted, so participants should pay attention to contract security. Currently, the Solana market is experiencing both capital rotation and liquidity constraints. Although star tokens have emerged, the chain is still filled with worthless assets. Fortunately, activity surged by 14% last week, mainly thanks to the expansion of DeFi projects.
What I find interesting about Junk Fund is that it doesn't just try to stop these tokens from dying out. What it wants to do is give these worthless coins a second life. What does that mean? Even in the dullest ecosystems, with buy-side liquidity completely gone, or with tokens that have lost all liquidity and become junk, there's still a dedicated group of fans for them, right? And there are also many holders who don't want to sell, so that force is still there. So the question is how to reuse this attention, create a new wave of buying, turn trash into treasure, and make the cycle fun again. I think this is what really makes this project interesting. So how can we see this kind of death as part of a system upgrade? How can we install a model for garbage collection and regeneration on the Solana chain? I think Junk Fund is something worth paying attention to. Love growth, not just defending the status quo. Will Wall Street's next trump card be ETFs or DATs? Is it more comprehensive in terms of institutionalization than the leading institutionalized crypto exchanges like Bitget? During this surge of Bitcoin towards $120,000, did anyone notice a story? Originally, ETFs were supposed to be Wall Street's gateway, right? But in the end, the digital asset treasury company DAT stole the spotlight. Let me explain in one sentence what DAT means. It's basically the corporate version of a Bitcoin ETF, but with active management rights. Enterprises can use their own funds to buy Bitcoin and Ethereum. These crypto assets are placed into the treasury, so when you buy this company's stock, it's equivalent to indirectly holding these crypto assets. In the past, only MicroStrategy was bold enough to directly put Bitcoin onto its company balance sheet, but now everyone is starting to follow suit. DAT is essentially a company version of a crypto fund. The company holds Bitcoin and Ethereum as its base assets, so when you buy its stock, it's like you're indirectly exposed to crypto assets. The difference is that with an ETF, you can only honestly hold the spot assets one-to-one, but DAT is much more flexible. You can add leverage, go long or short, right? Of course, that also means you can crash even faster. In short, DAT is like a high-powered crypto fund. The returns are more exciting, and your heart will race even faster.
As a pioneer of the DAT model, Strategy had spent $46.5 billion to acquire over 632,000 bitcoins as of September 15th this year. This accounts for 3% of the total supply. They have continued to accumulate coins through issuing debt and additional shares. Although criticized for selling $1 of assets for $2, they have maintained a market premium over the long term, and shareholder returns have far exceeded simply holding the coins.
The big breakthrough is that in the preferred market, the capital never comes due. There's no refinance risk. We're basically offering a perpetual US dollar yield forever. We're getting the capital forever. And so by matching a very long duration instrument on the liability side with a long duration asset, we're creating an indestructible balance sheet.
With the DAT market booming across the board, hundreds of companies are entering the field, and asset focus is converging on Bitcoin, Ethereum, and Solana. Among them, Ethereum-based DATs already hold 3.74% of the Ethereum supply, while Solana-based ones control 2.31%. Although there are certainly short-term arbitrageurs, the DATs that truly succeed may have even greater potential than ETFs.
So why is the DAT you mentioned more expensive than its net asset value? Actually, it's not mysterious at all. With an ETF, you can only passively hold it, but with a DAT, you have more flexibility, you can stake it, and you can also earn mining rewards. For example, take Bitterwise as an example. If Ethereum goes up by 60%, each of its shares could soar by 130%. Isn't that even more attractive than just holding the coins directly? Plus, you can finance at a lower cost, engage in mergers and acquisitions, and even make money on-chain. This operational model is basically a crypto version of a money printing machine. Of course, the bubble is also getting bigger and bigger in the process. If a bear market hits and prices fall, companies will be the first to buckle under regulatory pressure. Now, regulators are starting to target data companies as well. All right, today Nansen released some data showing that nearly 80% of September's trading volume came from institutions, which is double what it was at the beginning of the year. So the Byte Exchange is transforming from a retail trader's paradise into a new battleground for institutions. It's upgrading from a simple matching platform to an engine for market liquidity. With its underlying capabilities like smart matching and cross-chain settlement, Byte is no longer just pursuing speed. Instead, it's about retaining capital. It's precisely because of these features that Byte can compete on the same stage as Binance and HKEX.
The report shows that the proportion of institutional trading in Bitget's spot market rose from 39.4% to 72.6% by the end of July. The futures segment is even more remarkable, with the proportion of institutional market makers skyrocketing from 3% at the beginning of the year to 56.6%, making the leap from a minor player to a major force. This also aligns with the logic of institutional capital, as what they value most is liquidity. Now, Bitget's order book depth and spread levels can rival those of top platforms like Binance.
Generally, I feel all the very liquid, highly traded assets such as equities, bonds, and money market funds are easy to be tokenized, or at least if we do otherwise with them, there is a market, be it retail, institutional, or a combination of both.
According to on-chain data from Nansen, Lizard Digital Refibration Capital is the largest source of positive capital inflow for BitGet. In the first half of the year, BitGet's average monthly trading volume was about $75 billion. Of this, derivatives accounted for about 90%, with institutions contributing half of that, indicating that its capital structure has become fully institutionalized.
So in fact, centralized traders are all quietly transforming. First, they are launching decentralized exchanges on-chain, and off-chain, they are actively engaging with institutions. For example, in September, BitGet launched a crypto service platform to connect with banks, brokerages, and traditional financial institutions. Crypto.com had already set its sights on Wall Street early on, building a trading platform specifically for institutions. In October, it partnered with Standard Chartered Bank to launch a collateral mirroring service in Europe, meaning that your custodial assets are backed behind the scenes by Standard Chartered. It's all about custodial services. So as you can see, the competition going forward is no longer about how fast you can list new coins, but about who can win the trust of institutions and master the logic of regulation. The key to winning in the future will be the ability to understand the rules and to have a say in global finance. It's no longer about technical strength.
SpaceX is moving funds again. According to Look On-Chain, they just transferred 281 bitcoins into a new wallet. This is the third time in 10 days that Musk has made a move. He's been pretty active lately. This wave of government strikes in the US is really burning through money. According to the CPU, they've already lost $1.8 billion just this year, and it's not over yet. Losses are expected to keep climbing in the coming weeks. The crypto world's Halloween fireworks are here. $17 billion worth of options are about to expire at the same time. Bitcoin alone accounts for $14.4 billion. The call contracts are overwhelmingly one-sided, with the bulls in the market betting hard. Ethereum was emptied out again today. Analysts say that in just 2 days, 200,000 ETH worth $780 million were withdrawn. This move looks like big players are moving assets on-chain for storage, rather than getting ready to sell. An old whale has resurfaced. A wallet that acquired 222,000 SOL 5 years ago at $1.68 each just transferred 200,000 SOL worth $40 million into Coinbase, seemingly to take profits.
All right, from now on, Litang, be stingy when you need to be and calculative when you have to be. It's not that you've changed, but that you've finally realized people who don't cherish you don't deserve your generosity. Whether it's friendship, love, or family, as long as the other person never considers your feelings, don't waste any more time trying to patch up a relationship that's already out of balance. Remember this, anyone who can let you go isn't worth holding on to, and anything that can make you feel cold inside isn't worth explaining anymore. Remember, the actions have already been taken. Talking about it any further is just a cover-up. True maturity isn't about forgiving everyone, but about learning to turn away and leave gracefully. Sometimes indifference carries more weight than enthusiasm. Don't be afraid of being called stingy, because in this world, only those who know how to care for themselves are truly worthy. To be treated gently, if you understand, feel free to give a like. Well, that's all for today's program. Every day, we help you sort through all the news about Web3. We hope that this kind of summary can give you an intuitive understanding when you enter Web3, so you can make rational decisions. Here, we've also organized our membership benefits. Today is Thursday at 8 p.m., which is our regular, unmissable members-only live stream time. See you in the live stream room. We hope to hustle together with everyone in this bull market, gradually becoming wealthier. See you tomorrow.